Last week, silver didn't just move, it snapped. We're talking about a metal that dropped nearly 30% in a matter of days, from about $121 an ounce down to roughly $85 in Western markets, while at the exact same time, Shanghai barely moved, holding near $122. That's a 40+% physical premium showing up right now in real time, and both major bullion desks and exchange data just confirmed this wasn't new supply hitting the market, this was leverage blowing up. Stay with me, because what you do in the next few weeks depends entirely on understanding what just broke and what didn't. Before I explain what caused this, let me teach you something most people completely miss about silver. Silver isn't just a metal, it's a pressure vessel. It trades like a commodity, it behaves like a monetary asset, and it gets treated like a risk-on casino chip when leverage builds up in the system. Think of it like a tightly wound spring. The longer it gets compressed, the more violent the release when it finally lets go. When price goes vertical, that's not strength. That's tension, that's pressure building. And when that tension snaps, price doesn't politely drift lower like some rational reversion to the mean. It air pockets. It falls through space with nothing underneath it. That's why silver doesn't do gentle corrections. It does trapdoors. And if you've been watching metals for any length of time, you know exactly what I'm talking about. So when you see a parabolic run followed by sudden margin hikes from exchanges, you should already be asking yourself one question. Who's forced to sell here? Not who wants to sell, who has to sell. That's the difference between a normal correction and a mechanical liquidation event. Now here's what's actually happening. Let me break down the sequence step by step, because understanding the mechanics here is everything. Silver ran parabolic in Western paper markets over the last several weeks, driven by leverage, futures positioning, and momentum chasing. Classic melt-up behavior. As price accelerated higher and higher, exchanges did what they always do. They raised margin requirements. That's normal. That's standard risk management. But here's the cascade that most people miss. Higher margins mean traders need more cash immediately just to hold their existing positions, not to open new ones, just to keep what they already have. If they don't have that cash sitting around, they've got two choices: post more collateral or sell. And when you're leveraged 15 to 1 or 20 to 1, you don't have extra cash lying around, so they sell. That selling pushes price down, which triggers more margin calls on other traders, which forces more selling, and it feeds on itself. It becomes a self-reinforcing loop. But here's what's wild about this particular move. Physical markets didn't confirm it. Shanghai silver stayed above $115 per ounce, even as Western prices collapsed through 90, through 85. That divergence tells you something critical. The selling wasn't driven by end-user demand evaporating. It wasn't manufacturers saying we don't need silver anymore. It was paper deleveraging, forced liquidation by traders who didn't want to sell but had to sell. And when you see price fall while premiums explode, that's stress. That's dislocation. That's not weakness in the underlying asset. Now let me show you what very few people are talking about. We're not just seeing premiums in Shanghai. We're seeing delivery delays on physical product in Western markets. We're seeing spreads blow out between spot and futures. We're seeing backwardation in the forward curve. All of that happening at the same time tells you that physical metal is tight, even as paper price collapses. That shouldn't happen in a normal bear market. In a normal bear market, everything weakens together. Price falls, premiums compress, spreads tighten. But that's not what we're seeing. What we're seeing is a market that's bifurcating. Paper is selling off hard because leverage is unwinding. Physical is holding firm because actual demand for metal hasn't changed. And the gap between those two realities is where you find opportunity. Or risk, depending on how you position yourself. But here's the part that should make you nervous. We're now in price discovery. That means the forced selling either exhausts and we find a floor, or it doesn't and we go lower. And the difference between those two outcomes shows up fast. You don't get weeks to figure it out, you get days. This is the exact same playbook we saw in 2008. Let me take you back. Silver was trading around $21 in March of 2008. By October, it had crashed to under $9, cut in half. Liquidation selling, margin spirals, forced deleveraging. The whole system was coming apart. But what happened next? Silver bottomed in November of 2008 and then ran for 3 years straight, eventually hitting nearly $50 in 2011. The crash wasn't the end. It was the reset. It's the same movie from 2011. Silver hit its peak at nearly $50 in April of 2011. Then exchanges raised margins 5 times in 8 days. 5 times. And price collapsed from 50 all the way down to 26 in a matter of weeks. Nearly 50%. Everyone said silver was dead. The bull market was over. Fundamentals had changed. But zoom out. That crash set up a base that held for years, and silver eventually found its footing again. The liquidation event didn't kill the asset, it recalibrated it. And it's eerily similar to March of 2020. Remember that? Silver was at $18 in late February 2020. By mid-March, it had crashed to $12 as everything sold off in the COVID panic. Futures, equities, bonds, commodities, everything. But what happened? That $12 low became a generational entry point. 6 months later, silver was back above $29. The people who understood that crash was mechanical, not fundamental, made a fortune. Every time silver goes vertical, margin pressure follows. Paper collapses faster than fundamentals warrant. Volatility explodes. And then the market resets. Zoom out and you see the pattern over and over. Sharp crash, violent rebound, then either consolidation or a deeper retest before the next leg. In 2008, silver was cut in half before it ran for years. In 2011, the crash reset the market for a decade of base building. In 2020, the panic low became the entry point that launched the next bull phase. The larger story is this. Silver doesn't die in these events. It resets. It recalibrates. It shakes out weak hands and sets up the next move. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this still go lower? Absolutely. If liquidation resumes and we see another wave of forced selling, $70 to $75 is a real washout zone. That's where things get really ugly. That's where JP Morgan's $50 risk narrative that everyone laughed at suddenly sounds less crazy. Could we see that? Yes. Is it likely? I don't know. But it's possible, and you need to be aware of it. Could this be manipulation? Could there be entities deliberately pushing price down to trigger stops and force liquidation? Maybe. I'm not going to sit here and tell you markets are perfectly clean and nobody's playing games. But here's the thing. It doesn't actually matter whether this is manipulation or just leverage eating itself. The mechanics are what matter. Forced selling is forced selling whether it's orchestrated or organic. The mistake is obsessing over villains instead of watching signals. Focus on what you can control, volatility, premiums, key technical levels. That's where truth shows up. That's where you find your edge. And no, not every crash is manipulation. Sometimes leverage just eats itself. Sometimes markets get overextended and they snap back violently. That's normal. That's how markets work. The reflexive conspiracy thinking might feel satisfying, but it doesn't help you make better decisions. What helps you make better decisions is understanding the structure of what's happening and watching the data that tells you when conditions are changing. There are probably 3 types of people watching this right now. First, you're already long silver and you're rattled. Maybe you bought at 110, 115. Maybe you've been stacking physical for years and you're watching your unrealized gains evaporate. Totally fair. That's a rough position to be in emotionally. If you're in that camp, your job isn't to react to headlines. Your job isn't to panic sell into this weakness. Your job is to watch for stabilization. Does price hold that $80 to $85 zone without another leg down? Does volatility start to compress? Do premiums stay elevated in physical markets? Those are your signals. If price holds and volatility calms, forced selling is probably done. If price breaks lower on another spike in volatility, you might see that deeper washout. But don't confuse mechanical selling with fundamental collapse. The fundamentals haven't changed. Industrial demand is still there. Solar, electronics, medical applications, monetary concerns are still there. Currency debasement, deficit spending, geopolitical fragmentation. None of that changed last week. What changed was leverage. And leverage unwinds fast, but it also exhausts. Second, you're flat. You're sitting in cash and you're tempted to buy the blood. You're seeing silver down 30% in days and you're thinking this is the opportunity. I get it. The contrarian in you wants to step in when everyone else is running for the exits. But here's what I'd say. Patience beats heroism. Let the market prove to you that forced selling is done. Wait for stabilization. Wait for a few days of price holding without another volatility spike. Wait for premiums to stabilize or start compressing if physical loosens up. You don't get bonus points for catching the exact bottom. You get bonus points for entering when the risk-reward actually favors you. Right now, we're still in the danger zone where another wave of selling could take you underwater fast. So if you're flat and you're thinking about entering, scale in. Don't go all in at once. Test the water. See how price responds. If it holds, add more. If it breaks, you're not hurt badly. That's how you survive these moments. Third, you're convinced this is the end. You think silver's done, the bull market's over, maybe you sold already. Maybe you're just watching and shaking your head thinking I told you so. If that's you, I just say this. Zoom out. Silver has always looked broken at turning points. It looked broken in 2008 at $9. It looked broken in 2020 at $12. The people who called the top in those moments missed the entire next leg higher. I'm not saying this is definitely the bottom. I'm saying don't confuse a liquidation event with a fundamental breakdown. So here's the universal rule for all 3 of you. Don't confuse mechanical selling with fundamental collapse. Mechanical selling is forced. It's driven by margin calls, stop losses, risk management algorithms. It happens fast and it's violent. But it exhausts. Fundamental collapse is different. That's when the underlying reason to own the asset goes away. Industrial demand craters. Monetary concerns evaporate. Supply floods the market. That's not what we're seeing here. So here's what I want you to answer in the comments. Which camp are you in? Are you long and holding? Are you flat and waiting? Are you convinced it's over? And more importantly, what's your plan? What signals are you watching to know when to act? I'm genuinely curious because the way you handle this moment says a lot about your process as an investor. Now let me tell you where I stand. I'm not panic buying and I'm not panic selling. I'm watching. I'm in observation mode, waiting for the market to tell me what's next. First, I'm watching whether Western prices can hold that $80 to $85 zone without another volatility spike. If we get a few sessions of stable trading in that range, that tells me forced selling is exhausting. If we break lower on heavy volume with another spike in volatility, that tells me there's more pain coming. Second, I'm watching Shanghai. As long as Shanghai stays above $115 per ounce, physical demand is telling a different story than paper. That divergence matters. It tells me the selling is structural, not fundamental. The day Shanghai breaks down and starts tracking Western prices lower, that's when I'll reassess. But as long as that premium holds, I'm interpreting this as dislocation, not disaster. Third, I'm watching volatility itself, not price. Volatility. When volatility compresses, forced selling is usually done. When volatility stays elevated or spikes again, there's more liquidation coming. Volatility is the tell. It's the market's way of saying there's still urgent selling that needs to happen. So I'm watching the VIX for silver. I'm watching implied volatility in options. I'm watching daily trading ranges. When those start to calm down, that's my signal. Fourth, I'm monitoring premiums on physical product. If premiums start compressing back toward normal levels, that tells me physical supply is loosening and the tightness was temporary. If premiums stay elevated or go higher, that tells me physical is still tight, and this is purely a paper phenomenon. That distinction matters for how you position going forward. Based on my analysis, this crash was mechanical, not fundamental. It was a leverage unwind, not a demand collapse. The fundamental picture hasn't changed. Industrial demand for silver is still growing. Solar installations are still accelerating. Electronic vehicle production is still ramping. Medical applications are still expanding. Monetary concerns are still valid. Central banks are still running deficits. Currencies are still being debased. None of that changed last week. What changed was the amount of leverage in the system and the willingness of exchanges to let that leverage ride. When they pulled the rug with margin hikes, the whole structure came down fast. But that's a technical event, not a fundamental one. And technical events resolve. They exhaust. They create opportunities for people who can keep their heads while everyone else is losing theirs. If history rhymes and silver stabilizes in this $80 to $100 range, the move that follows could be substantial. Not because I'm predicting it, but because that's what happened in 2008, in 2011, in 2020. The violent shakeout set up the next leg. They recalibrate the market, flush out weak hands, reset sentiment, and create the conditions for the next move higher. Does that mean it has to happen? No. History doesn't repeat exactly, but it does rhyme. And the rhyme scheme here is pretty clear. I'm not a financial advisor. This is not financial advice. I'm sharing my analysis and my process. You need to do your own research. You need to make your own decisions based on your own risk tolerance, your own time horizon, your own financial situation. What works for me might not work for you. What makes sense in my portfolio might be completely wrong for yours. So take this as one perspective among many, and then go verify everything yourself. If you made it this far, you're the type of person who doesn't just react to price moves. You think critically. You want to understand the mechanics. You're willing to sit through a longer analysis to actually learn something instead of just getting hyped up or panicked. That mentality will serve you well, not just in silver, in every market you ever touch. The people who win long-term aren't the ones with the best tips. They're the ones with the best process. And you're building that process right now. If this breakdown helped you see the situation more clearly, share it with someone who needs to hear it. Subscribe if you want more analysis like this when the next major market event happens. And drop a comment telling me what you're watching right now. What signals matter to you? What's your plan? Let's build a community of people who think independently and don't just follow the herd off the cliff. Silver's going to do what silver does. It's going to be volatile. It's going to whipsaw. It's going to shake people out at the worst possible moments and make them feel brilliant at the worst possible times. That's the nature of the asset. But if you understand the mechanics, if you can separate forced selling from fundamental change, if you can keep your head when everyone around you is losing theirs, you'll be fine. Better than fine. Stay sharp out there. Think critically. Verify your data. and make decisions, not reactions.